Welcome to This Explainer, everybody. Today, we're diving into the ultimate tax saver's playbook for navigating Nigeria's Capital Gains Tax Act. Look, if you're doing business, acquiring property, or managing any kind of assets in Nigeria, understanding this specific piece of legislation is absolutely vital to protecting your bottom line.
Picture this for a second. You've just sold a major asset. Maybe it's a piece of land, a factory, or perhaps you've received this massive insurance payout after an unforeseen disaster. It feels like a huge win, right? But hold on, the government is waiting for its cut. It's a statutory obligation. And trust me, nobody wants to get on the wrong side of the tax authorities. But as the old saying goes, while you absolutely must pay your taxes, you don't have to pay a single naira more than is legally necessary.
So, before you go handing over your hard-earned cash, let's actually define what the capital gains tax, or CGT, is. Introduced way back in 1967, CGT is a tax charged on the financial gains that accrue to any person or company upon the disposal of a chargeable asset. In standard accounting, profits from selling fixed assets are usually excluded from regular income tax because, well, they're capital receipts. So the government basically created a separate lane entirely just for these specific types of gains.
All right, here's the magic number. For most chargeable gains in Nigeria today, you're looking at a flat rate of 10%. Believe it or not, it actually used to be 20% up until 1995, but they halved it to encourage investment. For corporate bodies, this 10% is administered and collected directly by the Federal Inland Revenue Service, the FIRS. Individuals, on the other hand, deal with their relevant state tax authorities.
Okay, let's get into our game plan. Today's agenda: 1. The basics of CGT. 2. Exemptions and allowable deductions. 3. Calculating your chargeable gains. 4. Strategic tax planning. And 5. Reliefs and real examples. Let's kick things off with Section 1, the basics of CGT. Look, the financial landscape, it's never static. You really need to know the current playing field because the rules constantly evolve. Recent finance acts from 2019, 2020, and 2021 have completely shaken things up. For instance, if you receive compensation for loss of office, anything below 10 million naira is now entirely exempt from capital gains tax. If it's above 10 million, the payer has to deduct the tax on the excess and remit it under PAYE, pay-as-you-earn rules. Also, gains from disposing of Nigerian government securities, like treasury bonds, are now fully 100% exempted.
Moving right along to Section 2, Exemptions and Allowable Deductions.
This right here is the absolute most important part of our playbook. We're playing defense through legal exemptions and allowable deductions. This is where you legally shield your money. Knowing which assets are totally exempt from CGT is your first line of defense. If you sell your main dwelling house, up to 1 acre of land, exempt. If the government compulsorily acquires your land for, say, a road project, that compensation is exempt. Passenger motor vehicles, life assurance policies, and even small movable assets sold for under 1,000 naira in a single year are all completely off limits to the CGT taxman. Now, you've got to pay close attention to the clear line drawn between what you can and absolutely cannot deduct when calculating your profit. You can legally deduct the initial cost of the asset, professional fees like surveyors or legal advisors, stamp duties, and even the cost of advertising to find a buyer. But here is the trap. You absolutely cannot deduct insurance premiums paid on the asset over the years. Just won't fly.
All right, on to Section 3, Calculating your chargeable gains.
So how exactly does the FIRS want you to crunch the numbers? It's a pretty straightforward 4-step process. First, you take your total sales proceeds. Second, you strip away the initial cost of acquiring the asset. Third, you deduct those allowable expenses we just talked about, the legal fees, the improvements. What you're left with is your chargeable gain. Finally, step 4, you simply apply that 10% rate to your final gain.
But wait, here's a massive warning directly from Section 5 of the Act. Listen closely to this one. Capital losses on one asset cannot be deducted from capital gains on another asset. If you sell 2 buildings and make a massive profit on one, but take a huge painful loss on the other, you still have to pay the full 10% tax on the profitable building. You cannot offset the loss against the gain. It's tough, but that's the law.
And this brings us to what happens when you try to get a little too clever with family members. The Act has this very strict connected persons rule. In our source materials example, a Dr. Mensa built a duplex and sold it to his uncle Jimmy for a very friendly price of 16 million naira. But the actual open market value was 20 million. Well, the tax authorities do not care about your family discount. They deemed the transaction artificial and calculated the tax based on the 20 million naira market value.
Let's pivot to Section 4, Strategic Tax Planning.
With the basics and those warnings out of the way, let's look at some advanced strategies for the tax-conscious business owner. A solid tax planning checklist requires proactive thinking. You should actively time your disposals depending on your financial year. Consider hiring equipment instead of buying it outright, because full hire charges are actually tax-deductible from your assessable income. Also, since stocks and shares are conditionally exempt from CGT in many cases, especially if you reinvest within the same year, it might be way smarter to invest your surplus cash in shares rather than real estate.
But listen, the absolute ultimate power-up in this whole playbook is something called rollover relief. This is a massive legal advantage under Section 32. Basically, it lets you defer your capital gains tax completely if you take the proceeds from selling an old business asset like a factory and reinvest those funds into a new replacement asset of the exact same class within 12 months before or after the disposal. It is a game changer.
Finally, let's hit Section 5, Reliefs and Real Examples. To really wrap our heads around this, let's look at how rollover relief works in a real-world scenario directly from the source's examination cases. Take the case of Best Manufacturing. Their factory tragically burnt down. Their insurance company paid out 5.9 million naira for a factory that originally cost them 3.7 million. So they've got a gain. They decided to build a new factory, but they only reinvested 4.6 million naira of that payout, putting the rest into a fixed deposit. Because they didn't reinvest the full amount, they couldn't claim full rollover relief. They had to pay a 10% tax on that uninvested 1.3 million naira difference. If they had just spent the full 5.9 million on the new factory, their tax bill would have been zero.
Now, always remember, the government is watching, and they have robust anti-avoidance provisions in place. Section 44 literally dictates that you cannot legally register a change of property ownership or get your documents stamped without producing a valid tax clearance certificate. The whole system is perfectly designed to ensure you comply right at the point of the transaction.
So by mastering these rules, navigating the connected person's traps, utilizing rollover relief, and knowing the exact list of allowable deductions, you are literally building a fortress around your profits. So ask yourself right now, is your current tax strategy leaving a fortune in hard-earned money on the table, or are you truly playing the game like a master tax saver? It might just be time to take a much closer look at your next big transaction.